Well, I think if more people recognize the problem and say, then they say we can do something about it, then things will happen.
Well, it bothers me that people are very dangerous when they invest. This word "play the market," that's a dangerous term. But if you do some work, do some research, know what you own, look at the research, look at the balance sheet. If you could add 8 and 8, get fairly close to 16, you can find out this company has lots of debt, no cash, they're in trouble. You shouldn't own it. So a little bit of research. People are careful when they buy a refrigerator. They're careful when they take a vacation. And they'll put $5,000, $10,000 some stock to hear on the bus or to party. That's dangerous. In the stock market, the most important organ is the stomach. It's not the brain. There's always, on the way to work, the amount of bad news you can hear is almost infinite now. So the question is, can you take that? I mean, do you really have faith that 10 years, 20 years, 30 years from now, common stocks are a place to be? If you believe in that, you should have some money in equity funds. I mean, it's a question, what's your tolerance for pain? And people want to invest, like in the stock market, they want to invest in the companies doing well, not the companies doing badly. Yeah. So if they say, this is a waste, why should I invest it? It's hopeless. You have to take away that hopeless and say, we can make this a lot better. Imagine if you were in a mall the last 50 years. You would have seen Gap when it was hot, you would have seen Limited when it was hot, you would have seen when it was not hot. You would have seen when they were starting, people weren't excited about Gap anymore. And then you do some research, say, well, gee, there's a lot of Limited stores, but we're only at 20. You know, they can go to 400. So you see a company. I did really well with Dunkin' Donuts, a local company. I did well with Stop and Shop. But people could see that this is really some people showing up, or I guess the Sunglass Hut, no one's there anymore. So I mean, that's research. That's fundamentals. More people lost money waiting for corrections and anticipating corrections than the actual correction. One of the things that surprises people, they don't understand the definition of management. It's getting things done through others. It's a lot easier to do something yourself. Yeah. If you have somebody else do it, and lots of people, obviously you're managing people, and sometimes you have to encourage them, sometimes you have to push them a little hard.
Yeah, right. Inspire,
people are different. It's hard.
Encourage.
But you have to understand what they want, you have to work with them, you have to explain yourself, you have to set goals, and you have to be a leader yourself, and you have to put a lot of effort into it. And you have to make mistakes. And there's a real amazing difference between being persistent and being stubborn. And I think great leaders could say, this is
persistence is good, stubborn's bad.
Persistence is terrific, stubbornness is terrible.
The way you beat the index is you avoid the stocks to go down. You avoid the steel companies and the oil companies and Sears and Penny, and where the companies are deteriorated. I mean, companies are dynamic. Behind every stock, there's a company. These are not lottery tickets. So you're trying to find the companies within the S&P 500 that are doing better. They're going from crappy to semi-crappy to good. That might take a couple of years, or they're going to grow for a long time. And you're trying to avoid the companies that are going south. That's how you beat them. Or you find some companies outside the S&P 500 that are great companies. CarMax was not in the S&P 500. They went up 200-fold. There's a lot of companies that enter, and a lot of their great performances before they go in. Would you say to yourself, do I need this money in a year? Do I need this money in 2 years? Do I need this money in 3 years? So longer term, stock market's been the best place to be last 10 years, last 30 years, last 130 years. But if you need the money in 1 or 2 years, you shouldn't be buying stocks. The key thing is when the stock goes from 10 to 6, if you understand what they do and you know they're financially solvent, you're fine. If you don't understand it, you can call the psychic hotline. But if you don't understand it, you're probably going to do the wrong thing. You know, if you understand exactly what they're doing, it's gone from 10 to 6, you'll buy more. If you're confused to start with, you'll say, well, there must be something wrong there. And then you're out. And then trying to predict the market is really a waste. So theoretically, the individual's edge has improved in the last 20, 30 years versus the professional. The data's there. It's free. If they want to invest, they ought to do the same kind of research they do when they buy a refrigerator. Or they take a trip to Italy. Do some homework.
You know what